Hi, welcome to Module 13, Shareholders Equity. I'll be covering the earnings per share section with you, and then another instructor is going to be covering the rest of the material in Module 13. Now, earnings per share is going to be really, really important, I think, in 2009. And the reason is because back in August of 2008, the FASB issued a press release, and in their press release, they're saying that they're issuing a exposure draft on a new accounting standard, and this new accounting standard changes the way they calculate earnings per share. And the reason that they're doing that is they're taking the old earnings, which is the one that's still in effect, which is standard number 128. It's FASB Statement of Financial Accounting Standard number 128, which is earnings per share. And they're going to be amending this so that it's more like the International Financial Reporting Standard for earnings per share. So they're trying to converge U.S. GAAP with International GAAP. Anyway, they issued this back in August 2008. The comment period was just up on December 5th of 2008. So that means that they're going to be issuing it sometime during 2009. Now remember that just because they issue a new accounting standard doesn't mean that it's immediately on the exam. There's always a 6-month lag period between when they issue something and when it actually gets started being tested on the exam. And I read you those rules back when we started with Module 7A. And remember that if an accounting standard does not allow early implementation, then it's 6 months after the effective date of the new accounting standard. And if they allow early implementation, then it's 6 months from the release date or publishing date of that accounting standard. Anyway, this is something that's going to be happening in 2009. Remember to always check our website and check our newsletter. Check also our webcast question and answer sessions, because anytime something is new, we're going to let students know. But the thing is what this means is that since a new accounting standard is going to be coming, all the questions that they currently have on the accounting standard in effect, which is standard number 128, and if they have any simulation that's in effect, it's more likely to be used now and tested now because they've invested a lot of time and effort and money into writing these questions, and these questions are going to have to be redone or thrown out and reworked to account for the new accounting standard after the new accounting standard comes. So that's why earnings per share is going to be particularly important in 2009. Okay, we are going to be working from both the textbook and the handout, so you're going to need your handout. You're going to need to take a look at page 12 of your financial accounting and reporting handout. You've already looked at this handout. When I went over Module 7D with you, at the bottom half, we discussed historical cost, constant dollar accounting, and current cost accounting. But now we're going to do the top half of page 12 of your financial accounting and reporting handout. And the top part of it talks about financial accounting and reporting, Module 13, stockholders' equity. And I'm going to be covering just earnings per share with you, and then another instructor is going to be doing the rest of the module for stockholders' equity. Okay, first of all, I want you to know that earnings per share, there are no debits and credits associated with earnings per share. Earnings per share is considered to be a required disclosure. When I talk to you about your multiple step income statement, let me go back. When you had your multiple step income statement, which was found in Module 7D on page 128, you had your statement of earnings and comprehensive income, which is found on page 128. Remember, I told you had to know the income statement, which was on page 128. You had to know the classified balance sheet, which was on page 132. I already talked to you on page 128 on the multiple step income statement, the different components that go to net income. And we learned that you have income from continuing operations, you have discontinued operations, you have extraordinary gains and losses, and then you have net income. Below net income, if you have a statement of income and comprehensive income, you could also have the other comprehensive income items, because this happens to be a statement of earnings and comprehensive income on page 128. So they have even some things that go below net income. But earnings per share is a required disclosure for certain components on the multiple step income statement. All right, before I go into that, I just want to talk to you about what is required for Module 13 just for earnings per share. Now, Phil will tell you what he wants, all right, for his section of Module 13. But for earnings per share, just for earnings per share only, I want you to do multiple choice questions number 55, 56, 57, 58, 59 and 60, 62 and 63, 65 and 67, 69 and 70. All right, I do also want you to do simulation number 2. I want you to read over the situation. That's a simulation number 2 now in Module 13. I want you to do the calculation for basic earnings per share. I want you to do the calculation for diluted earnings per share. I just want you to read the problem and read the solution for the communication. And I just want you to read the problem and read the solution for the research. Okay, the problem is found on pages 546 to 547, and the solution is found on pages 565 to 566. Now, in terms of the key words, the keywords are found on page, where did I put those keywords? On page 532. So if you turn to page 532, now obviously, folks, there's going to be a ton of keywords on here because it covers the entire module. I'm only going to tell you the keywords for earnings per share, and then if Phil gives you some more keywords, remember to check those ones off too. The 4 keywords for earnings per share on page 532, there's a separate section down towards the bottom. It says earnings per share and that list. On the left-hand column, basic earnings per share. In the middle column, diluted earnings per share. On the right-hand column, treasury stock method and the weighted average common shares. Once again, it's basic earnings per share in the left-hand column. The middle column is diluted earnings per share. The right-hand column is treasury stock method and weighted average common shares. Okay, so there's only 4 keywords. All right, then. Earnings per share does get started on page 523. So why don't we talk a little bit about page 523 let's just start at the top. On page 523, letter K talks about basic earnings per share. We're going to have to do both basic and diluted. It says CPA candidates must be able to compute, I'm on page 523 at the top, letter K. CPA candidates must be able to compute both basic and diluted earnings per share. In addition to the computations, candidates should also understand the presentation and the disclosure requirements. Okay, only companies, only publicly traded companies, public entities, those who trade their stock on a major stock exchange and over the counter are required to present earnings per share. A non-public company often chooses to present such information, but they're not required to do so. If they choose, if you're publicly traded, you have no choice. You have to follow this accounting standard. Publicly traded means you register with the SEC and you trade your stock on stock exchange. If you're not publicly traded, you may elect to do this, but if you do so, you have to follow standard number 128. You don't have to read the outline. I'm going to tell you everything that you need. All I want you to remember is that on the multiple step income statement, remember back on page 128, you had income from continuing operations, discontinued operations, extraordinary gains and losses, and you had net income. Earnings per share is required disclosure for all of these things. Okay, so you have earnings per share, basic and diluted, for income from continuing operations, discontinued operations, extraordinary gains and losses, and net income. So it's basic and diluted for each one of those. So there can be a potential of up to 8 different calculations for earnings per share. Now, what I'm going to do is I'm just going to tell you a little bit, I'm going to talk to you a little bit about what's the difference between a simple capital structure and a complex capital structure. Then I'm going to relate the simple and the complex capital structure to what's required for basic and diluted earnings per share. Then I'm going to tell you where in the world you have to report these things, and then we're going to work on how you do the calculations. Okay. Now, companies that have a simple capital structure, it's very, very simple. When they say capital structure, it means how do they finance themselves, okay? When they finance themselves, they have regular preferred stock, regular common stock, regular bonds payable. Nothing fancy. So you have preferred stock, common stock, bonds payable. That's it. That's a simple capital structure. If you have a simple capital structure, you only have to do basic earnings per share. But it would be basic earnings per share for I, D, E, and net income. Now, obviously, if you have an income statement that does not have a discontinued operation, or if you have an income statement that does not have an extraordinary gain or loss, then you don't have to do earnings per share for that. But the potential is there could be 4 calculations. It's basic earnings per share. Now, let's say you have a complex capital structure. If you have a complex capital structure, that means in addition to the preferred stock, common stock, and the regular bonds payable, you could also have convertible preferred stock. Convertible preferred stock means that the preferred stock can be converted over into shares of common stock. Also, you could have convertible bonds. The convertible bonds payable means that bondholders can convert their bonds into shares of common stock. Also, you could have stock options, also known as stock warrants. You can have stock options, also known as stock warrants. You can also have contingent shares. You can also have contingent shares. All of these are examples. Any one of them will automatically make you a complex capital structure. So, once again, simple capital structure, it's only preferred stock, common stock, regular bonds payable. Complex capital structure is in addition to those, you can have any one of the following. One or all of them will make you complex. That would be convertible preferred stock, convertible bonds payable, stock options, stock warrants, and contingent shares. Okay, so any one of those will make you a complex capital structure. If you have a complex capital structure, which is one of those complicated securities, the convertible preferred stock, convertible bonds, stock options or stock warrants, and contingent shares, then what happens is that you have to do both basic and diluted earnings per share. And you have to do basic and diluted earnings per share for I, D, E, and net income. So that's the potential now for 8 different calculations. Obviously, if you don't have extraordinary gain or loss, you don't have to do a basic or diluted for that. So it's only if you have them on your multiple step income statement. Now, I'm going to put an asterisk next to this. Net income and income from continuing operations. That's because for the 2 items that I've asterisked, income from continuing operations and net income, okay, both of these must be shown on the face of the income statement. So if you have a simple capital structure, you have to do basic for income from continuing operations and basic for net income. It must be shown on the face of the income statement. If you have a complex capital structure, you have to do basic and diluted for income from continuing operations and net income. As for the discontinued operations and extraordinary gains and losses, okay, you have a choice of where to show them. You can either show them on the face of the income statement or you have to do them in the footnotes, okay? So you have a choice, either on the face of the income statement or in the footnotes for discontinued operations and extraordinary gains and losses. But remember that the footnotes are an integral part of the financial statements. So if they ask you, all right, if they ask you, true or false, discontinued operations, earnings per share for discontinued operations must be shown on the face of the income statement. That would be false, because for a discontinued operation, you can either choose to show it on the face of the income statement or in the footnotes. But if they say true or false, discontinued operations earnings per share must be reported. That's true because I didn't tell you where to report it. It does have to be reported. You just have a choice of whether to show it in the face of the income statement or in the footnotes, because remember, the footnotes are considered to be an integral part of the financial statements and is reporting. Remember, I and net income must be shown on the face of the income statement. D and E, you have a choice to show it in the income statement or in the footnotes. Now, there is a typographical error on page 523. Down towards the bottom, page 523, you have these 3 bullets. The 3 bullets say discontinued operations, extraordinary items. You see the last one says the cumulative effect of a change in accounting principle. Please, that is a typographical error. Scratch that out. It used to be, we used to have I, D, E, A, which was the cumulative effect of a change in accounting principle, which used to appear here. That went away with standard number 154, and standard number 154, we don't have that anymore. So it's a typographical error in here. Please eliminate that. You do not have to calculate earnings per share for the cumulative effect of a change in accounting principle. You don't show that, okay? All right. Let me see if I can just show you a multiple choice question about where you report those things. Let's take a look at multiple choice number 60, please. Number 60 is found on page 540. Number 60 on page 540. Number 60 on page 540 says, earnings per share data must be reported on the income statement for the cumulative effect of a change in accounting principle. No, that went away. That was the old accounting changes in accounting principle. Once we had the new accounting standard, standard number 154, that totally went away. So the answer there, cumulative effect of a change in accounting principle, that would be no. For extraordinary items, the answer then would be, what's it say? Earnings per share must be reported on the income statement for cumulative effect of a change in accounting principle. That's no. That doesn't have to be reported at all. How about extraordinary items? The answer there would be, well, yes, it has to be reported, but does it have to be reported on the income statement? The answer there would be no. So the answer there would be no and no. The answer would be B, like Barbara. Now, what if they said, earnings per share data must be reported? You have to report this for the cumulative effect of a change in accounting principle. No. earnings per share must be reported. I didn't say where for extraordinary items. Then the answer there would be yes. So it would be answer C, no and yes, if they just said earnings per share data must be reported and they didn't tell you where. But the fact that it says that you must report it in the income statement, the answer would be no and no. You don't report cumulative effect of a change in accounting principle. As for extraordinary items, you have to report it, but you don't have to do it on the income statement. You can also do it where? In the footnotes, because our footnotes are considered to be an integral part of the financial statements. All right. The next thing that I want to do is I want to talk to you a little bit about the formulas. The formulas are on page 12, at the top of page 12 of your financial accounting and reporting handout. For basic earnings per share, which is on the left-hand side, they said that this is done for companies with simple or complex capital structures. So it doesn't matter if you're simple or complex, you always have to do basic. And then for diluted, this is on the right-hand side, this is done only for companies that have a complex capital structure that has potentially dilutive securities. A potentially dilutive security means the number of shares could potentially go up. So if the number of common shares goes up, then your earnings per share is going to go down, and it dilutes your earnings per share. That's why they call it diluted earnings per share. Diluted, happy hour, they dilute the drinks. It makes it weaker, diluted, okay? All right, so this is only done for companies that have a complex capital structure with potentially dilutive securities. Examples of potentially dilutive securities are convertible preferred stock, convertible bonds, common stock equivalents such as stock options, stock warrants. That's another term they like to use, is a common stock equivalent. Also contingent shares. So what I'm going to do then is I'm going to first show you the basic earnings per share formula, and then I'm going to show you the diluted earnings per share formula. Actually, let me just start with the diluted earnings per share formula, because you will see that the basic earnings per share formula is inside it. Because I'm all about making you memorize less stuff, okay? If I can show you, ooh, that's good. Cindy almost killed herself by tripping over her book. I drop things, I fall down. Once I remember when I was teaching, we teach up on the stage, and I walked right up the stage. Woo! I never hurt myself, though. You know why? Because I always fall down, because I'm so clumsy, and I'm just used to falling down all the time. Okay, you have net income minus the current year preferred stock dividends plus the net of tax bond interest expense all over the weighted average number of common stock shares outstanding plus your common stock equivalents. And what I'm going to do is I'm just going to draw a box, because this, folks, this whole thing is considered to be the diluted earnings per share, but what I put in the box is the basic earnings per share, okay? So just memorize one thing and just remember inside the box is basic. The whole thing's diluted. What's inside the box is basic. Okay. First of all, let me talk to you about the different components about the basic earnings per share. We understand net income, okay? Net income is from the income statement, like we showed you on page 128. The weighted average number of common stock shares outstanding. Basically, whenever you have a transaction, okay, that change in shares, whenever you have a transaction in shares that changes total shareholders' equity, you do have to weight that transaction. If you have a transaction which does not change total shareholders' equity, such as a common stock dividend or stock split, you do not have to weight it. What do I mean by weighting something? Let's just say that I start off on January 1st with 10,000 shares of common stock shares outstanding. If on July 1st I issue another 10,000 shares of common stock, by the end of the year I'm going to have a total of 20,000 shares. But the thing is that this asks for the weighted average number of common stock shares. So what I would do was, for the ones I start off on January 1st, which is 10,000 shares, I take those 10,000 shares and multiply that by 12 months over 12 months to give me 10,000 shares. To that, I would then add the 10,000 shares I issued on July 1st, but then I would multiply that by 6 months over 12 months, because from July 1st to December 31st is 6 months. So that would then equal 5,000, and the weighted average shares would be the 10,000 plus the 5,000 is only 15,000. So in my goofy little example, it would be 20,000 total shares outstanding, but only 15,000 of the weighted average number of shares. What other types of transactions would change total shareholders' equity? Purchases and sales of treasury stock, purchases of shares on sales of treasury stock would change total shareholders' equity. Also, issuing shares in a purchase business combination, that would also change your total number of shares. Okay, in a business combination, you have a business combination, you issue shares, that's going to change total shareholders' equity. You also have to weight that transaction. Things that you do not weight. Stock dividends, you do not have to weight. All right, you treat it as if it happened at the beginning of the year, and stock splits you do not have to wait. You treat it as if it was at the beginning of the year. The reason is because stock dividends are divided into two types of stock dividends. You have a small stock dividend and you have a large stock dividend. In a small stock dividend, which is usually typically less than 20 to 25% of the outstanding shares. What you would do is you capitalize retained earnings and you do things at fair market value. This is called a small stock dividend. And the journal entry that you would make is that you would debit retained earnings, and this would be done at the fair market value of the shares. You would credit common stock at its par value. So this would be the debit, this would be the credit, and then the difference would be a credit to additional paid-in capital in excess of par. All right, so you would debit retained earnings at the fair market value per share, credit the common stock at the par value per share, and then plug additional paid-in capital for the difference. And this would be a small stock dividend. If it was a large stock dividend, which is typically greater than 20 to 25%, and on the exam, they're going to make it obvious. It's going to be like 10%, which is really small, or 40%, which is really large. It'll be obvious like that. What you would do is you do these things at par value. Okay, and what you would do is you would debit retained earnings at the par value, and that would be the debit, and then you would credit common stock at the par value, and that would be the credit. No matter what, you're not changing total shareholders' equity. All you're doing is moving it from retained earnings to common stock and additional paid-in capital, or from retained earnings to common stock. So you do not have to weight these transactions. Okay, what about a stock split? What's the journal entry for a stock split? Well, that's a trick question. There is no journal entry for a stock split. There's only a memorandum entry that says, on this day, we split the stock 2-for-1, blah, 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 okay? There's not even a journal entry for that, so you can't even affect total shareholders' equity. So you do not have to weight stock dividends. You do not have to weight stock split. Things that you do weight, if you issue new shares, if you purchase or sell treasury stock, if you issue stock pursuant to a business combination, okay? All right, let's take a look then at how you can do the weighted average number of common stock shares outstanding. We're talking about how you calculate this number right here. Let's take a look at multiple choice number 58, please. Multiple choice number 58. Number 58 is found on page 540. Number 58 on page 540 says, what were TIMP's 2008 weighted average shares outstanding? So they want to know, what is the weighted average number of common stock shares outstanding? The TIMP company had the following common stock balances and transactions during 2008. On January 1st, 2008, the common stock shares outstanding was 30,000 shares. Then on February 1st, they issued another 10% as a common stock dividend. Now remember, you do not have to weight that because it's as if you had issued them at the beginning of the year. I'll show you how to deal with that. On July 1st, you issued common stock for cash. Would you weight that? The answer is yes. The reason you would weight that is because you're going to change total shareholders' equity. If the assets go up, remember, when you have your balance sheet, assets equals liabilities plus shareholders' equity. If your assets are going to go up, then your shareholders' equity is going to go up. So you would change total shareholders' equity. So you would have to weight that. And then finally, as of December 31st, 2008, the total of common stock outstanding would be 41,000, but they want the weighted average number of common stock shares outstanding. So what were TIMP's 2008 weighted average number of shares outstanding? Okay, well, first of all, what you're going to do is you're going to start off on January 1. You're going to start off with first 30,000 shares, and the 30,000 shares were outstanding the entire 12 months, so 12 over 12 is going to be 30,000. Then they say that you issued a 10% common stock dividend. If they say something like that, regardless of where you are, you stop. You do a subtotal. You say subtotal. Okay, the subtotal is 30,000. And then, if it's 10% dividend, you multiply it by 1.10. This happened on February 1st. But you don't weight it for 11 months over 12 months. You just take the subtotal and you multiply it by 1 plus the dividend, okay, which was 10%, 1.10. If they said they gave a 40% dividend, you multiply by 1.4. If they say they split the stock 2 for 1, then you'd multiply it by 2. All right? But you don't have to take into account the 11 months over 12 months for the period February 1st to December 31st. You don't have to weight it because it did not change total shareholders' equity. So then 30,000 times 1.10 is then going to be 33,000. And then you continue on with the 33,000. Then they said on July 1st, they issued common stock for cash, 8,000 shares. So on July 1st, they issued 8,000 shares. Now this you would have to wait because it's going to change total shareholders' equity. 8,000 over 6 months over 12 months is going to give me 4,000 shares. And that's because the period July 1st to December 31st is 6 months. Then you take the 33,000 plus the 4,000. Remember, this is 8,000 times 6 months over 12 months gives you 4,000 for the weighted average shares for that. You add the 4,000 to the 33,000, that gives you a total of 37,000. So let's answer the question. What were Tim's 2008 weighted average shares outstanding? The correct answer then would be 37,000 shares. The correct answer there would be D, like David. So the total number of shares outstanding is 41,000, but the weighted average number of shares was 37,000. Now let's just make this a little bit more complicated. Let's just say beginning then with what I had on July 1st, I issued the shares. That's 37,000 right here. So let's just do a little subtotal here. 37,000. I'm going to make this even more complicated, okay? I'm going to say that on November the 1st, I purchased treasury stock. So I buy treasury stock, and I bought 6,000 shares. Okay. So what would I do? Would that affect total shareholders' equity? Well, yes. Because when you have assets equals liabilities plus shareholders' equity. Folks, I'm just taking this example and extending the example because I think this might be on the exam, and the reason is because the accounting standard is going to change and they have to use up all their questions, okay? Not only that, if there's a simulation out there, they're going to have to use that up because they're going to have to change it next time because earnings per share is going to really be different because it's going to converge with the international standard. So you got to know this, all right? So let's say we buy treasury stock. If we buy treasury stock, 6,000 shares, let's say we do that on November the 1st. Well, then what would happen would be that if we purchase treasury stock, the journal entry would be to credit cash and debit treasury stock. The debit to treasury stock is a contra shareholders' equity account. So that would make shareholders' equity go down and your assets would go down. So assets would decrease because you're crediting cash, and shareholders' equity would decrease because you're debiting a contra shareholders' equity account. Shareholders' equity has a normal balance of credit. So we would have to weight this transaction. And the reason that we would have to weight it is because total shareholders' equity changed. So for the period from November the 1st to December 31st is how many months? 2 months over 12 months, so times 2 over 12. So that's about 1/6. 1/6 times 6,000 is 1,000. So here's a 1,000. But remember, I purchased treasury stock, so the number of shares outstanding went down because treasury stock is considered to be issued, but it's not outstanding. Treasury stock is supposed to be issued, but it's not outstanding. So we take that out of the works. So that would decrease the number of shares outstanding. Then I say, okay, then on December 1st, I'm going to sell, what's a nice number, 600. Okay. So if I sell 600 shares, am I going to have to prorate that? And the answer is yes, because when I sell the 600 shares, I'm going to debit cash, and I'm going to credit treasury stock. And so when I debit cash, and I credit treasury stock, this is once again going to change my total shareholders' equity. I'm going to increase my assets. I'm going to increase my shareholders' equity. So I'm going to change total shareholders' equity again. So I'm going to have to weight that. But shareholders' equity is now going to increase. So instead of being a subtraction, it would be an addition. So I would have to prorate it because I'm changing total shareholders' equity. So then on December 1st, when I sell the 600 shares, I would multiply that by 1 month over 12 months. So 600 divided by 12 is 50. So I would add back the 50. So then I would take 37,000 minus the 1,000 and add the 50, 37,000 minus the 1,000 plus the 50 is going to give me 36,050. And that would have been my weighted average number of shares outstanding. But wait, let's just say that on the very last day of the year, December 31st, on the very last day of the year, I do a 2-for-1 stock split. Would I have to weight that? December 31st to December 31st is zero months. The answer is no, you do not have to wait that because a stock split does not change total shareholders' equity. You don't even do a journal entry to do a stock split. You just do a memorandum entry only. So because it's a stock split, you don't change total shareholders' equity. You don't have to wait it. So then I would take the $36,050. I just do a subtotal, which is the $36,050, multiply that by 2, because I'm doing a stock split 2 for 1, and then the total weighted average number of shares would be 72,100. So you don't wait stock splits, you don't wait stock dividends, but you do have to wait treasury stock transactions, and you do have to wait business combinations. Okay, if you issue shares pursuant to a business combination. Okay, so the best answer then for 58, we stopped all the way here, it's 37,000. So the best answer there would be D, like David. Now I'm going to talk to you a little bit we talked about net income, we talked about the weighted average number of common stock shares outstanding. Let's talk a little bit about the current year preferred stock dividend. What do I mean by the current year preferred stock dividend? Well, when you have preferred stock can either be cumulative or non-cumulative. So cumulative or non-cumulative. Now let me talk a little bit about that. Cumulative preferred stock means that, what does preferred stock mean? It means that the preferred stockholders get their dividend first before the common stockholders get it. Cumulative means that if the board of directors does not declare a dividend on cumulative preferred stock, the dividend for that year accumulates to the next year. So if you didn't pay dividends in 2008, and then you decide to pay a dividend in 2009, and you have cumulative preferred stock, before the common stockholders get any dividend at all in 2009, you have to pay the 2008 preferred stock dividend in arrears, the 2009 preferred stock dividend, and after you back pay the 2008 cumulative preferred stock dividend, and you pay the 2009 preferred stock dividend, then the common stockholders can get paid. Okay, so cumulative means that the dividends roll over to the next year if they do not get declared and paid. Okay, now if it's non-cumulative means that the only way that the preferred stockholders can ever get a dividend is if they declare a dividend. It does not accumulate. So the only way to get a dividend is if they declare a dividend. So then you have to check, is a non-cumulative declared or not declared? For the cumulative preferred stock, it doesn't matter if they declared or not. They're always going to get paid it because it accumulates. It's cumulative. If it's non-cumulative preferred stock, you have to see, well, was the stock declared or not declared? Only for preferred stock non-cumulative, they'll only get it if it was declared. If it's not declared, they don't get it. All right? If it's not declared, then they don't get it. The thing is that when you look at this, you have to take the current year's preferred stock dividend. Remember, net income is for that year. It's for that period. And you're looking at the preferred stock dividend for that year, for that period. That's why it's only for the current year. So that's when you have to check the preferred stock dividend. If the preferred stock is cumulative, no matter what, you're going to have to subtract 1 year's worth of dividends. So you say, okay, you just take minus the current year dividend, okay? If it's preferred stock non-cumulative, then you have to see if did they declare the dividend. If they declared the dividend, you would say, okay, then you'll have to minus the current year dividend. When I say the current year, which year do I mean? Well, if they're talking about net income for 2009, I'm talking about the current year, which would be the preferred stock dividend for 2009. If it's non-cumulative and not declared, if they did not declare the dividend for non-cumulative preferred stock, then you would subtract 0. So once again, preferred, you have to go through a decision tree. Preferred stock cumulative, you'll always minus the dividend. Which year's dividend? The current year's dividend. If it's non-cumulative, you have to see whether it's declared or not declared. If it's declared, you'll subtract the current year. Now, if it's not declared, you don't subtract anything, okay? Because they don't get it, because it's non-cumulative and it doesn't accumulate and they never declared it, so they're never going to get it. Now, the thing is this. Oftentimes what they want to do is trick you about dividends that are in arrears. They could say, oh, the dividends are in arrears 2 years, or the dividends are in arrear 1 year. The thing is, you don't care about what's in arrears. You only care about which year? The current year, okay? So ignore previous year's dividends and arrears. You only care about the current year, and you have to go through that decision tree. Okay, let's see what we can do for some multiple choice questions on this. I think I want to do multiple choice question number 56, please. Number 56 is found on page 539. Number 56 on page 539. Number 56 says, in its December 31st, 2008 income statement, what amount should Ute report as basic earnings per share? Okay, so let's calculate this. The Ute company had the following capital structure during 2007 and 2008. Okay, if they say that this was their capital structure in 2007 and 2008, it means that their capital structure did not change, and it was like that the entire time. Okay, so they said the preferred stock is $10 par, 4% cumulative, 25,000 shares issued and outstanding. They take the 25,000 shares, multiply that by $10 per par. That gives you the 250,000. And the way they calculate the dividend, which, by the way, this preferred stock is cumulative, the dividend is 4%. And the way you calculate the dividend is you take 4% times the $250,000 total par value, and that'll give you 250,000 times 4% is $10,000. Then they have common stock, $5 par, 200,000 shares issued and outstanding of $1 million. Ute reported net income of $500,000 for the year ended December 31st, 2008. Ute paid no preferred dividends during 2007. Oh, so they're saying now that 2007, those dividends are in arrears because this preferred stock, it does what? It's cumulative, so the dividends accumulate. And they paid $16,000 of preferred dividends during 2008. In its December 31st, 2008 income statement, what amount should Ute report as basic earnings per share? Okay, you go through your decision tree. Is this preferred stock cumulative or non-cumulative? It's cumulative, so you're going to automatically subtract what? The current year's dividend. The current year's dividend is 4% times the $250,000 par value, which is $10,000. Why did they give you the $16,000? The answer is to confuse you. All right? Don't pay attention to that $16,000. You only want that includes some dividends and arrears. Don't pay attention to that. You only want the current year's preferred stock dividend. So the way we would calculate this is we would take the net income, which is $500,000, minus the current year preferred stock dividends, which is calculated because it's cumulative. You automatically subtract 1 year's worth of dividends. Which year? The current year. 4% times the $250,000, and that will give you $10,000. So you subtract the current year preferred stock dividends. You divide that by the weighted average number of shares outstanding. The weighted average number of common stock shares outstanding is going to be, let's see, they said it was outstanding what? All during 2007 and 2008. How many shares did we have? 200,000 shares. So that's 200,000 shares times 12 months over 12 months, which is 200,000. So basically it's going to be 500,000 minus the 10,000, which is the current year preferred stock dividend, divide by the 200,000. So it's 490,000 divided by the 200,000. 490,000 divided by the 200,000 is going to be $2.45. So your basic earnings per share is $2.45. The correct answer is going to be B, like Barbara. And oh, by the way, if you subtracted 16,000 instead, guess what the answer would have been? A. So be careful about that A, okay? Don't pick A unless you're absolutely sure. You can pick A, but you have to be sure. The correct answer here is B, like Barbara. Okay, let's see if we can do another multiple choice question. Let's take a look. Oh, this one is really, really tricky. Let's take a look at number 59. What makes number 59? What makes number 59 so tricky? It's just one word. One word. That makes it so tricky. If you look at number 59, which is found on page 540, this is akin to the multiple choice question I showed you back in module 11b on the bonds, where I told you they asked for the net proceeds instead of the proceeds, and the word net proceeds, net, made it completely different from proceeds, gross proceeds. This is another thing. It's one word in the stem that makes the answer totally different, and that's the word comparative. In number 59 on page 540, it says, what amount should Strauch report as basic earnings per share in its 2008 and 2007 comparative income statements? The fact that the statements are comparative, that means they have the same income statement and they have two columns of information. One says 2007 and one says 2008. if they had left out the word comparative, if they just said what amount should Strach report as basic earnings per share in its 2008 and 2007 income statements, they left out the word comparative. They're talking about two separate statements. One's a 2008 statement, one's a 2007 statement. The fact that they put the word comparative means that two columns of information, one for 2007 and one for 2008, are on the same piece of paper. Okay, so that makes the answer completely different. Okay, I will do it both ways, and I'll show it to you both ways. But number 59 says, Strach has one class of common stock outstanding and no other securities that are potentially convertible into common stock. During 2007, 100,000 shares of common stock were outstanding. Then, in 2008, two distributions of additional common shares were incurred. On April 1st, 20,000 shares of treasury stock were sold, and on July 1st, a 2-for-1 stock split was issued. Now remember, when you sell treasury stock, you're going to debit cash and credit treasury stock, so your assets are going to go up and your shareholders' equity is going to go up. Okay, so you have to wait that transaction because total shareholders' equity changes. And then on July 1st, they did a 2-for-1 stock split. Remember, a stock split does not change total stockholders' equity, so you do not have to wait that for 6 months over 12 months. You just do a subtotal and you double it. Net income was $410,000 in 2008 and $350,000 in 2007. What amount should Strach report as basic earnings per share in 2008 and 2007 comparative income statements? Okay, first of all, you cannot solve for the mutually exclusive answer in this question. The mutually exclusive answer is when you look at a column of information and the answers don't repeat. You can see under 2008, 178, 178, 234, 234, the answers repeat. If you look in 2007, you have 350. Then 175, 175, then 350, the answers repeat. So you cannot solve for one column. You have to solve for both columns and pick the answer. What I'm going to do first is I'm going to show you 2008, and then I'm going to work backwards for 2007. All right, for 2008, what was my net income for 2008, number 59? It says net income was $410,000 in 2008. So I'll put the $410,000 here. Okay. Now, do I have any current year preferred stock dividends? No. I don't have anything at all in here about preferred stock. There's no preferred stock going on at all. So the current year preferred stock dividend, you just ignore that because there's no preferred stock at all. Then it says that I had 100,000 shares of common stock outstanding during 2007. So I started off with that in 2008. So on January 1st of 2008, so January 1, I had 100,000 shares. I'm going to multiply that by 12 over 12 because they were outstanding the entire year, so that's 100,000. Then it says that on April 1st, 20,000 shares of treasury stock were sold. Remember, assets equals liability plus shareholders' equity. You're going to debit cash and credit your treasury stock when you sell your treasury stock. So your assets go up and your shareholders' equity goes up. Okay, so you're going to increase your number of shares outstanding. So that would be on April 1st. And it says that I sold how many shares? I sold 20,000 shares. 20,000. Now, for the period, April 1 to December 31 is 9 months over 12 months. So that would be, what, 15,000. Okay, so that's 3 quarters. Okay. Then they said on July 1st, they did a 2-for-1 stock split. So what you do then is you just take a subtotal, 115,000 shares. Okay, that's a subtotal. And then you double it. So on July 1st, you just say times 2. So then that's going to give you 230,000 shares. Okay, you don't have to wait this times 6 months over 12 months because you don't wait stock dividends, you don't wait stock splits because they do not change shareholders' equity. Stock splits don't even have a journal entry, so how can you change total shareholders' equity? So then in your denominator, you're going to end up with, all right, 230,000 shares. So you're going to say 410,000 divide by 230,000 gives me $1.78, approximately $1.78, and this is what it is for 2008. But you can see if it's $1.78 for 2008, we're either left with answer A or answer B. And remember I told you about A. They always give A as the most often chosen wrong answer. For 2007, for 2007, the net income they give for 2007 is 350,000. So I'm just going to say 350,000 here, and I'm just going to draw a little cloud around it. It's a cloud to show you that's for 2007, okay? 350,000 would be the net income. We still have no current year preferred stock dividends. There's no preferred stock at all. What would be the weighted average number of common stock shares outstanding in 2007? Well, that was 100,000. So then I would take 350,000, divide by 100,000, and that would give me $3.50 for 2007, right? No! If they had asked, what amounts should Strach report as basic earnings per share in its 2008 and 2007 income statements, and they left out the word comparative, then you're looking at 2007 by itself, and you're looking at 2008 by itself. And 2007 would have been the 350,000 divided by the 100,000 shares would have been $3.50. So then the correct answer would have been A if they have left out the word comparative from the stem. But because they put in the word comparative, meaning that you're trying to compare 2008 side by side with 2007, the stock split, and by the way, it would also apply to the stock dividend. The stock split or the stock dividend would have to apply because it does not change total shareholders' equity. And so what you would have to do is double the number of shares outstanding for 2007. So instead of it being just 100,000 shares, you would double it to take back the 2-for-1 stock split back to 2007. Instead of being 100,000 shares, then it would be 200,000 shares as a weighted average number of shares outstanding for 2007. And then 350,000 divided by the 200,000 shares. Remember, you took the 100,000, multiplied it by 2 to bring back the 2-for-1 stock split all the way back to 2007. Only because why? Only because it has the word what there? Comparative. So when you take the 350,000, divide that by the 200,000 shares, that gives you $1.75. So the correct answer for 2008 is $1.78. And then for 2007 would be 350,000 net income divided by 200,000 shares because you took those shares from 2007. You also doubled them for the stock split because it's comparative. Okay, so whatever you did for stock splits and stock dividends in 2008, you had to also do in 2007. That gives you $1.75. So the correct answer is B, like Barbara, because they had the word comparative. If they had left the word comparative out, then the correct answer would be A, because they're telling you to take 2007 by itself and 2008 by itself. Because they use the word comparative, they're doing them side by side. Very, very tricky. Not nice. Okay? All right. Now that we're done with the basic earnings per share, I want to move on then to diluted earnings per share. Now remember, you have to do basic for both a complex and a simple capital structure. Remember, a simple capital structure just has regular common stock, regular preferred stock, regular bonds payable. A complex capital structure would have all the other things from the simple capital structure, plus, in addition to the regular common stock, regular preferred stock, regular bonds payable, it could have convertible preferred stock, convertible bonds payable, common stock equivalents such as stock options and stock warrants are treated exactly the same, and then contingent shares, okay? Contingent shares. So, take a look then at the formula, which I already wrote up for you because I only want you to memorize one formula. It's this whole giant formula. I have just drawn a box around the basic earnings per share. But this whole thing is the diluted earnings per share. And I'm going to tell you, we're going to use what they call the if converted method. The if converted method for dealing with diluted earnings per share. The if converted method. That means if you converted everything that could potentially be diluted, what would be your new earnings per share? So it's sort of like a what if worst case scenario, because we're trying to be conservative here. We're trying to be conservative. So if you could convert everything you could possibly convert into shares of common stock, what would be the worst case scenario for your earnings per share? The formula is net income minus the current year preferred stock dividends. And what I'm going to do here is I'm going to put a little question mark here. And the little question mark is because if we use the what if method, what if we converted it all? If this happens to be a current year preferred stock dividend on preferred stock that is convertible, then we assume we convert all our convertible preferred stock into shares of common stock. And then if there was a number here for basic earnings per share, then it would go away for diluted earnings per share, because you pretend it becomes shares of common stock and then it wouldn't get a dividend anymore. Okay? Then you would put those pretend shares, because you're pretending that you converted all the convertible preferred stock into shares of common stock, and that would go here as a common stock equivalent. And that would also be weighted. For example, let's say that you issued convertible preferred stock on July 1st of 2008. So the soonest you could have possibly converted that over into shares of common stock would be on July 1st. So then you'd have to take the common stock equivalents and multiply that by 6 months over 12 months. So don't forget, you also have to weight that, okay? You also have to weight that. Now, what about the net of tax bond interest expense? Once again, I'm going to put a little question mark here. And the reason is if you had convertible bonds payable, which means that the bondholders can choose to convert all their bonds into shares of common stock. Well, if you pretend they're no longer convertible bondholders, that they're now common stockholders, well, guess what? They're not going to get interest payments anymore. So your net income, which is already subtracting all the interest expense, already subtracting all the interest and all the taxes on that, what you would have to do is add back the net of tax bond interest expense on the convertible bonds. So that's why I put a question mark there, because we have to see, are they convertible bonds or not? And then, since you're pretending they become common stockholders, they would then go in the common stock equivalents and become sort of like pretend shares. But once again, you would have to weight those, okay? This is not an easy concept. It's kind of like a tough concept. The best way to do it, to learn it, is to do multiple choice questions. Folks, I love multiple choice. You can never go wrong with doing multiple. People think that multiple choice, like, all right, I teach at like a very large public university in Maryland. And you know what they tell me? They're like, multiple choice just makes the exam look too easy. I'm like, are you kidding? There's no way. Multiple choice is so much harder because they can trip you up by putting all the wrong answers in there and then putting as the answer A. Multiple choice are really, really a good tool. Okay, that's why they're so great. That's why I like to do so many of them. Let's take a look at some multiple choice that have to do with diluted earnings per share. Okay, let's take a look. And one other thing. I want you to look on my handout. If you have to deal with stock options and stock warrants, okay, if you have to deal with stock options and stock warrants, there's one other last formula that I want to point out to you on page 12. It's sort of like on the right-hand side towards the bottom. Calculating the number of common stock equivalents. Now, this deals with stock options and stock warrants. What you're going to do is you have to deal with market prices. What you're going to do is you're going to take the average market price, you're going to subtract the exercise price, and then you're going to divide by the average market price to make like a ratio. And then you multiply that by the number of options. Now, you still have to weight that. So if they issued the stock options on July 1st, okay, they issued the stock options on July 1st, then you'd have to take the number of stock options or warrants and still multiply that by 6 months over 12 months, because there's no way they could be shares of common stock earlier than July 1st. So you'd still have to prorate them, okay? Also, you would only do this if the stock options were dilutive, meaning that they were in the money. What does that mean if they're dilutive or they're in the money? Okay. Well, we all understand what stock options are. They allow you to buy a share of stock, usually at a favorable price. Okay, so you have the market price and then you have the exercise price. The exercise price is actually the cash money that you have to pay in to buy the share of stock. Now, what happens if I have an average market price of 20 and my exercise price is 10? Is that a good deal? Market price of 20 and my exercise price is 10. That means I only have to pay $10 to get something worth $20. Is that a good deal? That's a very good deal, because you'll make a $10 profit, because then you could spend $10, buy this share of stock, and then sell it again for $20. You see that? So why is it then that's called, by the way, a stock option that's in the money. Now let's just say that you have the market price being $20, but the exercise price is $21. Would anyone ever pay $21 for something with a market price of $20? No. We would say that's out of the money, and it would be anti-dilutive, because you would be out of money if you paid $21 for something worth only $20. So you have to look at the relationship between the market price and the exercise price. And remember, the exercise price is the amount of cash money that they have to put in order to actually buy the share of stock. So why is it then, if you have a market price of $10 and a market price of $20 and an exercise price of $10, that nobody exercises their stock options? They're still all outstanding. And the answer is because they're greedy. And the reason that they're greedy is because they're hoping that the market price goes from $20 up to $100. So if it went up to $100, by the way, stock market has not been doing that lately. But if the market price, if the market price, average market price is $100 and you have an exercise price of $10, can you not see you can make a $90 profit? And so people are waiting for the price to go up higher and higher and higher, and then they'll make a real killing. So the reason that you have in-the-money stock options that are still unexercised, where the market value is $20 and the exercise price is $10, is because they're waiting for that market value to go up so they can make more money. Okay, so anyway, you only consider those stock options that are considered to be dilutive or in the money. You ignore the ones that are out of the money. Okay, let's just take a look at a multiple choice question on this. I think I want to do multiple choice question number 62, please. Number 62 is found on page 540. Number 62 on page 540 says, what is the number of shares that would be used in computing diluted earnings per share for the year ended December 31st, 2008? I'm actually going to do both basic and diluted, and I'll show you the answers for basic and diluted. Because you know what? I have a feeling that this might end up being a simulation, so you really got to know this stuff. The Mann Company, I'm doing number 62 on page 540. Number 62 says the Mann Company had 300,000 shares of common stock issued and outstanding on December 31st, 2007. On July 1st, 2008, an additional 50,000 shares of common stock were issued for cash. You have to weight that because you change total shareholders' equity in that date. Mann also has unexercised stock options to purchase 40,000 shares of common stock at $15 per share. That's $15 per share is the exercise price. This is outstanding at the beginning and the end of 2008. The average market price was $20. You can see that it's in the money. That's because you could pay $15 for something worth $20 and you would still make money. What is the number of shares that should be used in computing diluted earnings per share for the year ended December 31st, 2008? Well, I'm going to do both basic and diluted. First of all, for the basic, which would be inside the box, you'd first start off with January 1st, okay? And they say that they had 300,000 shares of common stock issued and outstanding at the beginning of the year. December 31st, 2007 is the same thing as January 1st, 2008. So this would be 300,000 shares times 12 over 12, which would be 300,000. Then they said that they issued an additional 50,000 shares on July 1st, 2008. So on July 1st, 50,000 shares times 6 months over 12 months would be 25,000, so that your weighted average number of common stock shares outstanding for basic earnings per share would be 325,000. So if they had asked for basic earnings per share, the answer would be 325 and the answer would be A. But because they wanted diluted, you have to deal with the common stock equivalents. And the way you deal with that is you take the stock, to calculate that stock options, you take the average market price minus the exercise price all over the average market price, and you still have to multiply that by the number of options or the number of shares, okay? So the average market price was 20, the exercise price was 15, and the average market price was 20. So 20 minus 15 is 5. 5 over 20 is about 1/4. So this would be 1/4 times the number of options. And the number of options in this case is unexercised stock options of 40,000. So that would be 40,000. So that in turn would be 10,000 of your common stock equivalents. Now this 10,000 still has got to be prorated, and it still would be multiplied by 12 months over 12 months, because remember, the stock options were outstanding the entire year. So then you would take the 325,000 of weighted average number of common stock shares outstanding plus the common stock equivalents of 10,000, and that would give you 335. So the correct answer for number 62 would be answer B, like Barbara, for diluted earnings per share. But if they ask for basic earnings per share, then the answer would be A. So it's 335 for diluted. The answer is B, like Barbara.